So what we do know today is everybody is very concerned about the threat of global inflation, to the extent that the ECB has decided to hike rates in Europe by 25 basis points. Recently, we've seen the Central Bank of Nigeria move in a similar direction, and the Bank of Kenya. How serious is the situation from your perspective?
Well, if we're looking at the key threats facing African economies in 2011, there's no question about it. The threat of rising inflation is right up there. We've seen, of course, the fuel price increase. There are concerns about global food prices, and we can talk at length about why that at least is different from what we had seen in 2008. But what has really changed things around is the speed of pass-through. Look at what has happened in East Africa in particular in recent months. That rise in inflation from February to March, almost double digits in Kenya, in double digits in Uganda. This, I think, is a wake-up call for policymakers.
You talk about the speed it's passed through. So what's led to that speed? Some would say really it's the oil price because of the crisis in the Middle East and North Africa. And once we have political resolution there, things will stabilize a little bit.
Well, it's a mix of factors. At Standard Chartered, of course, we've raised our oil price forecasts for this year. We think that we're going to see that average of $115 a barrel, at least for 3 quarters. And if we see any surprises, well, those are likely to translate into upside risks. But in the context of East Africa, oil is only a part of it. Of course, we've also seen a great deal of currency volatility, and that has exacerbated the impact of imported oil. Looking at the dependence on imported oil in East Africa, it is that much higher than it is in other regions, and that, of course, has fed through into inflation. Unfavourable weather helping to lift food prices, but that very rapid pass-through suggesting that the impact on growth might be felt sooner.
Let's talk about mitigating factors and scenarios. We've also seen inflation creeping through in the Asian tigers, those leading economies, but we're told that because they're growing above 6, 7, 8%, they'll be able to manage it. And so what we're seeing by way of tightening monetary policy is just a way to sort of retain equilibrium. Africa is also growing fairly well, above the global average. Will that help?
Well, the concern, of course, is precisely in those countries where the negative output gaps that had been in place after the crisis have closed very rapidly. And in the case of a lot of Asia, we've actually got a positive gap in place in terms of having exceeded the levels of growth that one might have anticipated. Now, that makes it a very, very difficult call for policymakers because, of course, there's been immense pressure on Asian central banks to tighten interest rates, something they were hugely reluctant to have done last year because of the fear that that would just exacerbate currency strength. We've seen something of a turnaround. Now, in the context of Africa, we need to look very carefully at what had been driving more positive growth rates in the run-up to the global economic crisis. Some would say it was the achievement finally of single-digit inflation, that macroeconomic stability that was responsible for the good growth, the rise in consumption, the rise in investment that we had seen. Not only do we see an inflation threat now, we need to think very carefully about whether it leaves behind a lasting impact, because that would potentially be negative for African growth.
Let's talk about mechanisms available to central banks in Africa. And I know Africa is not one homogenous group, but there's no one size fits all. So we're seeing tightening in Nigeria, in Kenya. We're seeing rates on hold in a country like South Africa. We're seeing the Bank of England also saying rates on hold and not following the approach of the ECB. So which is the best approach? Because some are dealing with inflation targeting, others are dealing with managing inflation and growth at the same time.
Well, I think you hit the nail on the head in saying Africa is not one country, and what policymakers will have to do is look very carefully at the fundamentals of their own economies. Now, the Nigerian economy is expected to grow at a healthy pace. It's seen an incredible rise in government spending, up 50% year on year last year, and we're seeing spending at least being achieved to the same levels this year, according to the recently revised budget. In Kenya as well, we had seen initially a slow recovery from the events of 2008, not really helped by the drought, but things are changing now. South Africa is very different. This is still a country where the pace of economic recovery is disappointing, and that necessarily will have an impact on how the Reserve Bank assesses risks. For the moment, there is a reluctance to do anything too knee-jerk with policy, simply because of the weakness of that recovery.
I mean, you spoke about volatility of currencies being a compounding factor as well, and what we have seen with the crisis in North Africa at the time was a sell-off of African bonds, particularly impacted South Africa. With inflation creeping through, it's likely to have some bearing on inflation-linked assets. How badly will African bonds be impacted?
Well, part of the problem for Frontier Africa is Frontier Africa had never been a particularly big beneficiary of those huge capital inflows into emerging markets. So yes, in South Africa last year, good healthy inflows into the bond market. Those of course have reversed somewhat now. That's in line with global themes that are occupying the market. But the problem is perhaps even more stark for the frontier countries, which hadn't seen the big inflows into their bond markets, are now seeing this correction in yields because of inflation expectations, because of investors thinking inflation is going to get that much worse. At what point does it all end? The challenge for central banks is to stay ahead of the curve and not delay that tightening response, especially where it's needed, for too long. Maybe if yields come back to levels that investors find attractive in real terms, that will bring in stabilizing inflows. In the context of inflation being the single largest threat facing African economies this year, central banks need to think very carefully about how they accommodate currency strength.
Worst case scenario, Razia, already, we're told that the yields on US Treasuries have started to rise because of the sluggish recovery in the United States and globally. Now, we've seen a situation where there's this ebbing and flow. Investors want to come to emerging markets and then they think, oh, let's go back to traditional markets. So in a situation where inflation goes above expectations, how badly will we be affected?
Well, what we're watching particularly closely at Standard Chartered is, of course, Chinese CPI, which we expect might peak around May, June this year, and that could be at uncomfortably high levels. Given that we usually see a risk-related sell-off volatility in markets around that time, that may well prove to be the trigger to see more broad-based risk aversion. Emerging markets would suffer in that regard. So you have a very uncomfortable scenario where not only do you have still relatively weak growth in the mature economies, you've had emerging markets being the engines for growth but having bigger inflation issues to contend with, and you have this supply side shock to oil. Very crucially, it's not necessarily only because of the strength of demand, it's because of the supply side, and that can cause greater volatility.